Hey guys, and thanks for tuning in again to Kip's Tips. Well, today I want to take a little bit of a step back from some of the previous episodes, some of these previous sessions, because out of the gates here, we've gone over quite a bit in the channel. We've talked about the 401k, we've talked about the IRA, we've talked about the HSA, we've talked about budgeting, we've talked about saving up for that emergency fund. I've briefly touched on a couple other different topics, which I'll do some more videos on moving forward, but there's just been a reoccurring theme here. And what is the theme of this channel? What's the point of this channel? The whole point of this channel is so that I'm relaying the information that I've been learning to you guys so that you can potentially get some interest, do some research on your own, and then also use that research and use that newfound knowledge to help accumulate yourself some wealth, some generational wealth for you, for your family, and for the future. So how do we do this, right? We can do all these different ways. We can invest in our 401ks, our IRA, all that stuff that I've talked about. We can do budgeting, we can do all that. But what is this? What is investing? What are stocks, right? How can I utilize these things? How would I start? Rob, I've never invested in my life and I don't even know how to get started. Out of the gates here, and a lot of traditional traders might hate me for saying it, but do yourself a favor and download Robinhood and take a look at it. Now, when I'm telling you to download Robinhood and take a look at it, I don't mean go to Robinhood today and buy Tesla, buy Microsoft, buy Apple, buy Amazon. I don't mean go in and find that stock that appreciated by 5,000% today and try to ride the green wave up and then you can sell it at the top if you ever sell it. And I'm not telling you to go in and gamble. I'm telling you to download Robinhood, take a peek at it, start watching the market. That's one thing that I jumped in, right? I made a mistake. This is one of those time machine moments of jumping in, and I could have gotten away with some profits. I think I sold at a loss because I wanted to just get out, which is its own lesson. Don't fear, don't panic sell. You should actually hold for the long term. Buy things that you think will go long term, and don't panic sell. We'll talk about panic sell in another video. But I think you guys should take a look at Robinhood, and like I said, don't buy it, just start tracking the market. Start looking at the S&P 500, start looking at the triple Qs, start looking at the Dow Jones, start looking at all the different index funds that are out there for you to potentially invest in. Now, the big difference between an index fund and an individual stock is actually a big difference, because an individual stock is literally just an individual stock. So in the case of Tesla, let's say that you bought Tesla in March at the dip at a really low price in the hundreds or whatever it was, and you rode it all the way up through it hit like 2K, and you held it through that and you sold it at the top. You could have made a killing, absolutely. But let's say you didn't. Let's say you missed it. Let's say that you bought it at 2,000 and then all of a sudden there's a drop recently. I mean, there was a stock split, so the price looks different today, but let's just say you bought it at the top and then it dropped. Well, you just bought something on the way up. You picked an individual asset and you incurred a lot of extra risk, which with risk comes reward. So if you make that call the right way, now you're going to get a lot of money and you could be in a great way. But if you didn't make that call and you bought Tesla at the peak, or you bought Bitcoin at the peak and then that dropped down, you wouldn't be sitting pretty. So how do we dodge this? We buy index funds. Index funds are baskets. These are baskets of all the different stocks. So Tesla's actually not in the S&P 500. They were being considered for the S&P 500, but the S&P 500, that they ended up not doing that. But basically, the S&P 500 is all your different favorite companies, all the biggest companies in the US, the top 500 companies in the United States. So Apple, Microsoft, Walmart, Coke, all these big companies, that's basically what you're buying. So instead of having your money in the 5 companies that you researched that may or may not perform well, you're going to have your money sitting in something that is basically spread out. It's diversified. It's spread out so that you've got less risk, right? So now what are you doing? You are investing in something that's actually more so tracking the market right? So we're instead of picking a stock which our value goes up and down based on the value of that stock, now you're in an index fund of 500 companies, the top 500 companies in the US, which basically gives you a snapshot of the US economy. Now you're basically investing in something that tracks the progress of the US economy. Now we're getting into it. So why would I want to do that? You'd want to do that because, again, you're going to be more diverse. And if you look at the history of the market, you look at the market trends over the last 100 years, I believe, and I could be a little bit off here, but it's about 10% over the last 100 years, the market has appreciated in value. So I'm not saying the S&P's done that specifically, I'm saying in general, the market over the last 100 years has done about 10% gains. So what does that mean? That means that every single year, if you put $1 in, well, let's say you start year one, you got $1. At the end of that year, you'd have $1.10. You got 10% additional. It went up 10%. So the value of the money that you bought, whatever price you bought it at, if it goes up 10%, now you, instead of having $1, you have $1.10. Now that happens next year. What is 10% of $1.10? It's a little bit more than 10 cents. It's going to be like 11 cents. I don't know what the math is there, but you get the point. So now, if you put your money into something that's basically guaranteed over the course of 100 years to go up by 10%, and you can capture about a 10% gain over 30 years, 20 years, 10 years, hopefully, depending on what the market does, then you're going to be in a very, very good spot in that period of time. But again, if you pick one of those individual stocks and you're riding the individual waves of that instead of tracking the market, you're just going to have a lot more volatility with this one versus the S&P 500, which is kind of doing this versus, that, right? We want less of that and more of this if we can. We don't really ever want this, right? We never really want to lose money. We don't ever want these to depreciate in value. So here's one thing that I'll say. Just because you're investing in an index fund doesn't mean that you're completely safe from a falling economy, right? If a bear market hits, you're going to get hit too, no matter where you go, unless you go to cash, which we talked about. Cash is its own thing. You want to have some cash, but you don't want to have too much cash because you do want your money to be working for you. So we do want this diversity. We want this opportunity of getting this 10% gain over the course of average 100 years, hopefully over the course of 20 years. But there is a risk, and there's a chance that this economy goes down. Now, panic selling, we talked about this a bit ago. So when I first got Robinhood, I bought in, and then I saw the value go down, and I panic sold. And honestly, I wanted to put it into a better investment, so I had a real reason to get that money out. But you don't ever want to see something go in the red and then panic sell it, because if it's going down and it's dropping in value, you should look at that as a buying opportunity if it's something you believe in. If it's something you truly believe in, which is why you probably should have bought it in the first place. If you're going to buy an individual stock, you want to do your research and you want to make sure that there's a reason you're buying it, and there's got to be a purpose for your belief that this thing, Tesla, Microsoft, will go up over the course of time. But if you invest in the S&P 500, you're going to be basically in the top 500 performing companies, and you're not going to have to deal with the swings on the regular day-to-day stock trades, right? You're going to have less fees and transactions. But if you are experiencing a down wave and you're in one of those index funds, hang on. Don't panic sell. Do not panic sell, because there's a saying, when there's blood in the streets, that's when you want to run towards it. I mean, you want to, when everybody's running away from something, you want to run at it. Now, I'm not saying go buy a falling knife. I'm not saying go buy, the 100% like the way down, right? Because you never really know when the dip's going to be. But maybe you buy like a little bit on the way down, and then maybe you can buy a little bit more when you're more sure there's a bottom. Hopefully you could make that call if you do enough research and you're really tracking it enough by watching the market every day on Robinhood. You can just download it on your iPhone and track it. But I really just want to let you guys know that there's really it's really simple, because it's just the buy and hold strategy. If you believe that the last 100 years for the U.S. economy, by going up 10% on average every year, on average, is going to stay true for the next 100 years, then it's really the best bet you can do, because history showed that it's going to perform well for us. I really think that it's something everybody should dive into. Everybody should look at an index fund, because there is less risk than buying an individual stock or buying, well, I don't want to say that, but that's all I got for you guys today. So there is a difference between an index fund and a mutual fund. Maybe you've heard of a mutual fund. That's something that I'd like to dive into in another video. I'll tell you right now, I guess really the big difference between those two is that an index fund tracks the market and a mutual fund tries to outperform the market. So you've got actual people trying to pick individual winners here, whereas with an index fund, you're just picking the top performing companies. That's the one that got the 10% year over year. 90% of investors are actually going to go with this option, because the 10% that's over here that tries to beat the market and tries to outperform the market typically doesn't perform as well as the people that just pick the index fund, which just goes up 10% year over year. All right, guys, thank you guys so much. I just wanted to give you guys a little bit more of a conversation as to what investing is today, how you can get started, how you can start to look at it. And maybe one day we'll even dive into the Robinhood app and talk about buying. Other places that you can get it is Vanguard, you can go to Charles Schwab, you can go to Fidelity. There's so many different places that you guys can go to start looking at this, start tracking the market, even download your Apple stocks. There's an app on your iPhone for stocks. I think it's literally called Stocks, but just start checking it out. I want to dive deeper into this with you guys. If you have any questions, if I need to dive deeper into something or re-explain anything, please feel free to leave a comment below. Feel free to subscribe, hit the like button. I can't wait to just keep pumping out content for you guys and giving us more and more to think about, more and more to discover together, and hopefully in the end, make a better world. Thanks, guys. Thanks for stopping into Kip's Tips.